Every summer at the WSOP, once the final card is turned and a new world champion of poker is crowned, a quieter but equally consequential story unfolds away from the felt, and that is the reckoning with tax authorities. According to the yearly analysis published by tax professional Russell Fox, the 9 finalists at this year's final table combined to win $30,250,000 in prize money, yet more than $12.27 million of that total, a staggering 40.5%, was consumed by taxes before a single dollar reached the players' pockets. That effective rate marks a jump of roughly $2.2 million in absolute tax collected compared to previous year's final table, making the IRS and various state and foreign tax authorities the biggest winners of the series once again, a narrative that has become an annual tradition in poker media coverage. The tax treatment of WSOP winnings hinges on 3 overlapping factors: a player's country of tax residency, whether that country has a reciprocal tax treaty with the United States, and, for American residents, which state they call home. US citizens are subject to both federal income tax and self-employment tax on poker winnings treated as a trade or business, plus whatever state income tax applies where they live. Foreign players from treaty countries such as the UK or Austria historically pay nothing to the IRS at all, since those treaties exempt gambling winnings from US withholdings entirely, though such players may still owe tax back home depending on their domestic laws. Russell Fox's 2026 calculation note that this year's final table happened to include no UK or Austrian representatives, meaning there was no player who escaped taxation entirely, unlike in prior years when treaty beneficiaries occasionally kept 100% of their prize. As in tradition, the champion pays the single largest dollar amount in tax simply by virtue of winning the largest prize. Lucas Jumalon's $10 million top prize was reduced to nearly $6 million after $4 million was withheld, a personal tax rate of 39.9%. This liability reflects the double burden of federal income tax and self-employment tax that hits professional poker players, the same combination that hit 2025 champion Michael Mizrachi, who paid the IRS nearly $4 million and kept $6 million of his identical $10 million prize despite being a Texas resident with no state income tax exposure. The real disparities emerged from where each player lived rather than how much they won. Jamie Shaevel, who finished 7th for $1.5 million, suffered the single hardest tax rate at the table at 50.3%. As a resident of California, the US state with the highest state income tax, Shaevel owed roughly $598,000 to the IRS and an additional $157,000 to California's tax authorities, leaving him with just around $744,000, less than half of his nominal prize. Michael Gagliano, a New Jersey-based pro who finished 4th for $2.75 million, faced a similarly punishing combination of federal, self-employment, and state income taxes totaling $1.33 million, or 48.4% of his winnings, the second highest burden at the final table. International tax treaties dramatically reshaped the payout hierarchy further down the table. Lauri Saaskilahti, a Finnish player who resides in Spain and finished runner-up for $6 million, owed no US withholding tax whatsoever thanks to the US-Spain tax treaty, but Spain's own tax authority still claimed approximately $2.77 million from him, a 46.2% effective rate that left him with $3.23 million. That tax treaty exemption meant Lauri's post-tax gap over third-place finisher Greg Mueller narrowed to only around $600,000 despite a $2.25 million difference in their nominal prize. The tax situation for Canada is unfortunately unsettled. The Quebec tax agency Revenue Quebec believes that professional poker players owe Canadian income tax, while Canada Revenue Agency is far less aggressive towards professional poker players. Press reports say Greg Mueller is semi-retired. If that's the case, and he isn't a professional poker player, the only tax he owes is the mandatory 30% withholding to the IRS, netting him $2.62 million. Sixth place finisher Rami Hammoud similarly faced no Canadian income tax obligation on his winnings, as he was not a pro poker player, but still had to hand the IRS 30% of his $1.75 million payout, leaving him with only $1.23 million. Han Feng in fifth place paid $890,000 on a $2.25 million prize money. Mario Booz, a French professional poker player, finished 8th, earning $1.25 million. While Mario escapes paying anything to the IRS due to the US-France tax treaty, France is anything but a low-tax environment. The maximum marginal tax rate is 45%, and there is an additional 3% surtax on income in excess of 250,000 euros. Mario will end up paying an estimated $543,000 to tax authorities, leaving him with just $706,000 after tax. Finally, there is 9th place finisher Evagoras Evagorou, who won $1 million. Cyprus's tax system is similar to the US, with residents being taxed on their worldwide income up to a maximum marginal rate of 35%. The US and Cyprus do not have a tax treaty, so 30% will be withheld off the top of the IRS. He should be able to claim a foreign tax credit for the withholding of his $1 million winning, so his 35% tax bite to the tax department of Cyprus will be just 5% at around $50,000, netting him $653,000. Collectively, the table's after-tax total came to $17,976,000, meaning the players kept less than 60% of the total prize money. 2026 stands alone as the most heavily taxed final table in the modern era at 40.6%. For comparison, 2025 was 32.3%, 2024 was 36.7%, and 2023 was just 33%. While Jumalon walks away with roughly $6 million, various tax authorities collectively claim over $12.2 million, making them the true winners of this year's WSOP.